Welcome to this week's Closing Bell. It's March 28th. It's crazy. We're almost through another week. It's Good Friday tomorrow, celebrating the resurrection of Jesus. But Good Friday. Markets are closed, right, Mark?
Yeah, for sure. Friday, obviously, Jesus died on the cross, and then Sunday's here, baby. Easter, risen from the dead. That's what we're celebrating this weekend. So good stuff, right? And yeah, markets are closed on Good Friday. We'll be back on open back on Monday, ready to roll. So
we're filming this on.
And the quarter's over. It's the end of the quarter. Today was the final trading day of the first 3 months, which have been really positive. So it's been good. So looking forward to what happens in the next quarter here. So
Absolutely. So trading day is officially done at the time of filming here on Thursday afternoon. S&P 500 does what you just insinuated, notches its best start to a year since 2019. So like you said, up over 10% already, which is interesting because we talked about this last week. We expected mid-single digit returns for the year. So are we on the are we on the precipice of maybe a slight little downdraft in the market from here, or can we go up again? We hope we're wrong. We hope it's way better than it was than what we were predicting, but we could see a nice little correction here, huh?
Yeah. So, but traditionally, so when you have runs when you have a start like this, I mean, it can longer term continue. Yes. Do we need a pullback or some kind of sideways actions? Absolutely. And we've been calling for that and think it's going to happen. And, we keep going up in here. So it's, all said, yes, it should happen. But I think my concern with even that, Jason, is everybody's saying the same thing in regards to that. Everything I read, every financial deal, everybody's waiting for this pullback. And when the pullbacks happen, even in a day, you get a down market and then boom, buyers coming in, just looking for somewhere to go. And so, anyway, so yes, it's overextended. I think there's still great opportunities in stocks, dividends payers for sure. But yet the growth stocks keep going up. So again, I think it's back. I mean, it's funny, it comes back all the time to the fact that nobody knows. The experts, the smartest people in the world, and I'm not saying, you're not claiming to be. We've been having our opinions on that too.
What?
We all have an opinion on what it's doing, and then it's humbling because it at some point you're not going to be right, and so it's really it's quite a fun game. It's so that's why I love it. Reminds me of sports, and you could play a game, you're on the flow, and then you think everything you can't lose, and then all of a sudden you're out of sync, and a team that is just rolling all of a sudden isn't, and everybody's going what happened to him? It's just kind of the same thing in markets. It's really interesting.
Absolutely. So this week's topic, we thought we'd kind of foreshadow election season coming up here. Primaries just ended. Fun fact, we've got over 4.4 billion people around the world voting in their country's elections. I think it's over 76 elections around the world going on. Some have already taken place. Taiwan elected a kind of a pro-independence president, which could kind of escalate or aggravate tensions with China, who obviously wants Taiwan back under their control. And then you've got the long-term president over in that small country called Russia, Vladimir Putin, who won in a landslide, interestingly enough. So, big surprise there. So, but all eyes this year are going to be on our elections. So we thought we'd kind of break down some common mistakes that maybe some investors make, personal thoughts on what really is going to matter this year. So let's dive into it. I'm going to use this PDF here by Capital Group as a guiding point because I think there's a lot of good information. Their Capital Group's constantly voted some of the top educational content out there year over year. So again, it's very straightforward, very easy to talk through. But again, this is just going to help guide and aid our points that we just want to kind of bring across, right, Mark? So why don't you talk about this a little bit? talk a little bit about political parties, right? People on both sides of the aisle talk about Republicans, Democrats are best for the market. Well, what does this show us here?
So, all right, dude. So this is a subject that gets me riled up because I'm pretty hardcore conservative. Um, you look at longer term. It really it as time says and as it's gone. A lot of times, whoever's in it really is an indifference. Interesting indifference from an investor standpoint. It really not a huge difference as to who is in the majority as far as politically in the current year. We get nervous about it. Right now, there's a lot of angst about this upcoming election and so forth, and maybe more so than ever, possibly. So you said, well, it's different now. It's different, but it's interesting to go back and look at history because this history often repeats itself. You can see here that that basically there's not been a huge difference between the two long term, depending on who's in there. So this shows basically a hypothetical. And our point is not to get into necessarily the politics, but as investors, it's really important to see that through all the different. This graph is showing like an hypothetical $1,000 investment invested back in 1933. Today would be, what is that, 10 million or
Over 10 million, yeah.
21 million by the end of 23. So that's a huge increase. And, you see the ups and downs through it all. And you see, reds where Republicans are and, like this middle ground. And I can't, Mark, it's on, you're sharing it, but you can see in every situation, you've had flat periods, down periods, and then up periods. So it really depends. Again, as investors, the stock market depends on earnings per share, and what particular companies are doing, how the economy's being affected. That's really what the stock market is longer term focused on. Now, short term can be on political, who's here. You get these certain situations. I remember was it 2016 when Trump, there was this, Trump surprised everybody and won, and the market just tanked. And then all of a sudden they turned around and ran through the rest of the year and actually moved up. So you can have these short-term volatility issues with particular, election results, but longer term, it really hasn't mattered a whole long time. So as investors, it's really important, in our opinion, to stay invested.
Absolutely. We'll talk about that in a second, but to go along with your point. So again, the chart showing Democrat and Republican presidencies, got to look macro, look bigger picture, earnings per share, revenues of companies, but starts kind of at a more macro level, right? Like how the economy is doing, inflation numbers. I mean, obviously those numbers are going to impact top and bottom lines of company profits, and the consumer, and basically, who America votes for, right? So, I mean, you've got, every year there's an interesting piece that we saw talking about, however the economy is kind of going in that presidential election year, let's say it's doing really well, that bodes well for the incumbent, and vice versa. If the economy is not doing well, or inflation's sky high, or there's cracks in the ground per se, that might be a time for a change, right? We've seen that in elections past. So, but to your point, I like that point. Just say, looking out long term, like as investors, you don't really look at who's the president. That's just one person. I love this saying. Presidents get too much credit for when things are going good and too much blame for when things are going bad, because again, there's so much going on around them. Senate, House, majority, minority, like gridlock. Is it a unified government? What's again inflation like? What's the job situation like? What's going on in the world geopolitically, like wars. There's so much that we can get into the weeds on here, and specific issues that do drive macro and microeconomic factors. But again, for the purposes of this podcast and election years, let's look at it through a different lens. Okay, so why don't you talking about a little bit during election versus non-election years? This has been an atypical year, right, Mark, in terms of how the market's done so far this year?
Yeah, I mean, we've had this. I mean, we're getting this run that we've had recently is all based on interest rates. It's been since November. That's been the focus, and the fact is, when they started pausing on raising rates, and the economy seems to continue, the consumer seems strong. Whether it's through credit cards or whatever, it's just the fact is that the numbers have been stronger than expected, and so it's so we thought maybe interest rates were going to come down, but they're kind of staying where they are for now, and there's all that going on. But really, the election, in my opinion, at the moment hasn't had any effect at all in the markets. Now, that doesn't mean now going forward.
Mhm.
The second quarter, we just ended the first, second, third. Now we're through primaries. We know as far as president goes, it's Biden and or Trump. So it's there'll be some volatility in there based on again some of the emotions that come
Policy
around.
positioning. Yeah.
Yeah, policy positioning, but yeah, it's been really interesting. And this graph here shows again, it's just kind of the same thing that we saw before, whether you have a election years in the bottom and versus non-election years. They both have moved kind of they tend to be volatile primary season, but markets have bounced, back strongly usually after that. And so,
Yeah.
it's again, it's an interesting, yeah, we'll see how it all plays out.
Q3, Q4 usually responsible for the largest portion of earnings,
Yeah.
or growth of an index, especially the S&P 500, in election years. So those are some really interesting points. And then even talking about sectors, right? Obviously, I think a lot of this is driven by policy. So, for example, you look back at a specific president per se. It's really interesting to see that like a range of 1 year returns. If you broke down the S&P by sector, 1 year before an election, 1 year after, the 1 year after is quite interesting. You look at energy's, done really well 1 year post-election cycle. So,
Yeah.
And anything that we should be looking out for, maybe talk about specific, opportunities maybe that would pop up throughout the year, right? We've had an incredible AI run. Maybe value makes a play, with inflation's here to stay. Well, that kind of rhymed. That was nice. Talk about that a little bit.
Yeah, I mean, I think there's always opportunities in the fact that I think in election years, the volatility actually can create those buying opportunities, right? You got, depending on, who looks to be ahead, and healthcare, for example. There's a lot of ideas and differences between the conservative and Democratic Party in regards to how
Yeah.
funding of it all, whether it's vaccinations, all these types of things. Energy is another place, right? I mean, you got one, Trump is drill baby, comes in, he's going to open it back up like he did, in the first term. Biden's like, no, 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 we're going electric. We're
No
going
matter
electric
what. Yeah.
no matter what. And so, that could be EV space, depending on how that goes, that could be an area that you could provide, a lot of volatility, and energy, those two kind of bind each other possibly in this election year. So I think it gives us, opportunities in either one of them. I don't know in tech, a lot of there's certain areas that are just so like AI. It's hard to say like,
Yeah.
either. I'm not really sure either party really is dependent on how that one works, because that's just like that's full go live heading in semiconductors, all that, right? It's just I don't know. Yeah, but other ones definitely have. But yeah, it definitely can be a difference
Opportunities.
in that, give opportunities to invest. So again, long term, that's why we choose really good managers and people that we trust and have been doing this a long time to find those opportunities when they come. So that's why it's really important to stay invested even through it all.
Good points. So let's talk about mistakes investors make, because there are a few that everyone, even ourselves included, right? When you're managing your own money, there's something about it that makes you like second guess, like what's smart to like what you're feeling at the moment, like your gut. Uh, let's talk about how like the funds kind of flow during election years, not during election years. It seems like there tends to be a kind of a flight to safety as we come up to an election year, right? Where money market funds tend to raise, which this chart shows here, right, Mark? I mean, we're already there. I think just with the economy, you've seen almost $6 trillion, right? That's sitting in cash and money market funds right now. So I think we're there. We saw that in the year 3, kind of proof in the pudding right here. But what's the negative of investors staying too long in money market and potentially missing the potential upward trajectory of the market post election being decided?
Well, yeah, I mean, a great question, and you sort of just answered it. That's it. I mean, the fact is that typically when our emotions get involved, and when we are strong on a subject, especially regardless of politics or whatever. And again, I've seen this over and over again in election years, and then the year after an election, especially, where certain, either side of the aisle, people that lean one way or the other have a tendency to be really concerned once the other party wins, right? And so I saw this after the 20 when Biden won this last time. It was very interesting, to have some people were just like, oh my gosh, we're gonna go, everything's gonna, this guy's gonna crush us, and in certain areas, yeah, but then the market's done really well, and so those same people have really, because of maybe, being really conservative and putting money away somewhere else and kind of hiding it until they feel more comfortable. Usually, you don't feel comfortable until the market's moved tremendously back up to the upside, and so you've missed real opportunities, and the markets are down and so forth. So there's study after study that says when our emotions are involved in this type of, especially, and this is a big emotional area, it really can hurt you long term, because anytime your biggest, whether, saw it actually in 2022 when the markets dropped, everybody's panicking, they're starting to, you get this big washout finally, where just, I can't take it anymore, I got to get out. And usually that's where the smart investors are actually getting in. So the key is, again, to have a diversified portfolio, in my opinion, to where you don't have to panic out of anything or get so wound up. Just stick with your guns. Whether you're a conservative investor or more aggressive, stick with what you want to do, but stay invested, because there's always something that's going to be in an upcycle.
Time in the market beats timing the market every time. So that's a great point. And then again, just going back to your initial point. So let's say you're, whether you're a conservative or a Democrat, that, before Trump, when you find out that Trump won, or even before that, you're already in money market, and Trump wins, and the market, I think, tumbled about 1,100 points that next day. And then it was basically straight up from there for 4 years. I mean, we had really strong returns year over year in the S&P 500 and all the major indexes. So just saying, like, you could have missed out on a large portion, depending on when you got back in, of returns because of your personal feelings and emotions on something. And then vice versa. You did, going back, great financial crisis, 08, 09, Obama comes in office. Maybe some people were already heavily in cash, just because of everything that was going on in the economy, right? Not knowing what was going to happen. That was basically that period following that was basically the greatest bull market we've ever had in terms of stock market performance. So it's to your point of focus on your goals, focus on the long term, and don't try to play into emotion. It's hard to do. It's easy to say and hard to do, right? That's why a lot of people do.
Yeah. That's why, yes, it's a killer. It just crushes performance when we get too emotional about things. So I've seen it over and over again, and I've made the mistake at times to do it. So just I think, again, and not specifically to elections, but just markets and so forth. Just usually the average investor normally does the wrong thing at the wrong time, based on when you're emotional, you'll make the wrong decision at the wrong time. Something that you should have done months ago if you're really that concerned or thought it was, now you panic out at the bottom, or that's kind of the concern now in the sense of, and again, we're not talking about why you want to see the market at such, it's gone up so much. I start getting nervous when all of a sudden everybody who's typically been really conservative in their investing, all of a sudden like, hey, I want to get more
Yeah.
aggressive as the market keeps going up. And I'm like,
Uh-huh.
oh boy, and I've seen that in market tops, or those euphoria, fear of missing out, to where you jump in. So have a plan and keep with it. That would be always the suggestion.
Great advice. You're always so wise, Mark. But last thing I want to touch on before I let you go here is Boyer Financial's kind of outlook. Again, this isn't meant to be polarizing, but in my opinion, so I'll start just by saying, so what are the markets going to do, dependent on, well, I guess the question would be, uh, how would the markets act in a more favorable way? So what would be the best, most advantageous avenue and route for the market to go up? What would make the market go up? A Biden presidency or a Trump presidency? In my opinion, just looking at the policy differentials, I think the markets would favor a Trump presidency just because he is a more pro-business, pro-growth oriented policy president, where Biden has wanted to increase corporate taxes, increase personal taxes. And then you've got on top of that, both sides of the aisle spending exorbitant amounts of money right now, right? So like
Yeah.
what's going to help us kind of get out of that? And I think the kind of the more optimistic, pragmatic approach to cutting red tape, growing, GDP growth increasing, and kind of releasing the hounds per se, in terms of allowing America to be the hub of growth and ingenuity that it has been, right? Whoever can offer that, I think
Yeah.
that's going to kind of drive corporate profits, wages, and ultimately market growth over the long term.
Yeah, I mean, all true. And, I would agree with that for the most part. I think, anybody who's pro-business, really gets rid of regulation, um, really gives the entrepreneurs of this country, reduces taxes, reduces the, kind of the idea of, not trying to control them, the, uh, you know, price, the earnings, supply and demand, supplying people, giving them a chance to actually get out and produce more products and services without much regulation. I think anytime you have the weight of the government on the economy, it's a negative thing. So at the current time, it feels like that feels heavier even now with, a lot of things that Biden's been doing, a lot of, it just feels like it's heavier and heavier. Here in California, you see, Gavin Newsom, and they've raised the minimum wage up to $20 an hour, which always sounds great. I mean, yeah, because we want people to make more money, but when you have a company, and now you have to pay people $20 an hour that you were paying 16 or whatever before. That it's not, that money just doesn't come out of nowhere. It actually gets passed on to. Yeah. So when you have government involved in these things and creating like this, just all these regulations, it really causes problems, and, creates problems. So I think right now it seems to be, that seems to be the problem. And so that's probably why, you're thinking, and I agree, I like to have somebody in there who is more, from the president through all the way down, the ballot to
Uh-huh.
locally. I want to see people that are more, um, allowing companies to actually go out and let the economy run, let it go, let reduce the regulation, and let us make things happen. Because once that happens, history shows, much as you want to try to debate it, the history shows that if you lower those regulations, give companies a chance to make profits and grow their businesses, it creates jobs, and in fact, everybody's income comes up, right? All these
Uh-huh.
different things, are increasing. So yeah, that's part of that. Yeah, I think you're right on that. And it's going to be interesting to see what happens. Again, back to our, longer term, it may or may not matter who's in that
Yeah.
situation, but But I think long term for this country, I guess what I'm worried about is it feels like so much more government control, almost like this socialist, like, hey, you can only say these things or blah blah blah. There's a lot, it feels like our freedoms are getting taken away. I think that's a really concern. It's probably going to be a big part of obviously it's going to be a big part of the elections this year.
Yeah, I definitely think that we're in an era of government capitalism where basically it's been an artificial injection of capital by the government, right? The spending, through tax money, through bonds, treasuries being issued, bills, notes, and bonds, and then just trying to keep up with interest payments and keeping the government open. We've seen a few shutdowns averted already over the past, few years, especially. But again, I think the main thing about that is like all of that money injected, the M2 money supply exponentially increasing post COVID, right? All that free money handed out, and then having it sucked out like a vacuum this last year and a half, 2 years is going to start kind of playing its way through the system. And so I think the growth that you've seen, the GDP growth, the spending that's been so powerful has had a lot to do with government. So what you're talking about, and it's really interesting. And the more people can see that and say, hey, like maybe what do you think is going to happen if we have a strong economy and the Fed starts cutting rates like they did in the 70s? Well, isn't that going to make inflation worse because people are going to be spending money again? Because then if you've got a strong economy that's still humming along and you're cutting rates, that's basically easier to borrow money, easier to spend money. Could spell a little bit more of a difficult, prolonged period of kind of interest rate sensitivity, especially for the bond market.
Yeah, it's possible. I mean, that's what there's a lot of similarities between now and in the 70s, and I think the Fed's trying to keep an eye. They know that too, and they're being judged against that. But
Yep.
the fact is, it's so like big government. Government wants to continue to grow. I think that's our biggest adversary at the moment in our country is the size of our
Agreed.
government. No doubt about it.
Big governments don't work.
I want leadership that understands that and reduces that piece and allows the free people of America to continue to be free and also to eliminate the barriers that are causing us to to not be able to really grow our businesses, our families, the way we want to. That's what this country has been built on. That's
Yep.
what we need to continue to be. And so that's what I'm all about. So it's I think that's some really, really important. Get the government out of our lives, and again, we need regulations. This is not saying you get rid of everything and it's all free. Like, but the point is, give me an incentive to go get something done, and I'm free to go try to make a company, build something, take care of my family, blah blah. I'll go out and
Buy a
work
house. Yeah.
a house. I'll go work my tail off to do that, right?
Mhm.
But if I don't have that incentive to go do it, I'd rather, whether I work hard or not, I still get the same pay or whatever. That's no incentive. There's no greatness in that. I want to bring out the greatness. I want to see the greatness of the American people come out again. And it feels like that's not happening right now for the most part. But
Great. I appreciate. Yeah. Appreciate the candor, but that's all we have for you this week on the presidential election cycle, what it means for you as an investor. Stay the course. Time in the market beats timing the market, and just stick with your goals. If you have any questions, you can always reach out to us. But until next week, have a happy Easter.
Easter.
We'll see you next one.